Right. My very good friends, welcome to our session for this week. First of all, I would like to uh, apologize uh, for what happened on Friday. It was beyond my control. We couldn't do class. And then today again, when I tried to do it in the evening, and then you see that there's a change in the timetable, which was not there. Originally, we're not supposed to be having load shedding at that time, but I'm very sorry for that. Right. So that's why there's this inconvenience of you get this time and then you get that time. But considering that we are writing, that's why I've tried to think that maybe whatever way we have to sort that out. Right. So now let's look at right. Last time when we were together, we are looking at internal growth, whereby the entity was just using its funds to expand its business by investing in maybe more new equipment, buying using like opening a new shop and stuff like that. That is internal growth. But now we are now shifting from internal growth. We will now be dealing with external growth, whereby the business can buy other businesses outside. Right now, this one can be either through what we call vertical growth, or it can be horizontal growth, or it can be a conglomerate. Right. When we talk about horizontal growth, this is whereby a business acquires another business which is at the same level. For example, if ShopRite acquires Pick and Pay, if BP acquires Shell, right? If Varsity College acquires Brooklyn College, they are exactly at the same level, and they buy one of the companies buys the other. Then we also have what is called vertical integration. With vertical integration, a business is acquiring a business which is not at the same level, which is at a different point of production, either its supplier or its customer. As an example, a furniture company can buy a wood producing company so that they secure their wood. Then we can also have a retail shop can buy like a furniture manufacturing company can also buy retail shops where they were selling their products. That is vertical integration. So you're either buying your supplier or you are buying your one of your customer along the way, along the production line. Right. Then we can also have what we call a conglomerate, whereby businesses that are unrelated can be acquired. For example, BP can acquire Rosebank College. Sivanye Gold can acquire Spa. So the industries are unrelated, right? All those ways are ways that a business can expand, right? It can be a merger, or it can even be a takeover. With a merger, the businesses, they talk to each other, they negotiate on the deal, and everything is done whilst all the parties in the deal will be understanding what is happening. Whereas in a takeover, sometimes it can be negotiated, but when we say a merger, they are coming together, the two companies. So maybe they can create a vehicle, a new company, whereby A and B come together and form C. But with a takeover, one company is absorbed by the other. Right? This takeover can be friendly, whereby they negotiate whilst they are doing the takeover. Or it can even be what we call a hostile takeover, whereby the other company is taken unwillingly. As an example, your competitor can buy 2% shares in your company, then buy another 3%, then buy another 4%, then buy another 5%. Then when they've bought more than 50%, they announce that they've bought you. Or maybe you are in financial trouble. You are seeking an investor, but you don't want your competitor to buy. Then you are not getting the capital, and your company is almost liquidated. Then the competitor bulldozes and buys your company. So that can be a hostile takeover. All right. So the major issues that arise in our module when it comes to these types of deals is the valuation of the business that is being acquired. When you are buying a business, you need to know what is the value of this business before you buy it. And also when you are selling your business, you need to know how much is your value of your business so that you know how much should you charge. It's just like you when you are selling a laptop to me. I should know those types of laptops in the same condition for how much are they being sold out there whilst I'm negotiating with you. At the same time, you also should also know those prices. How much are they being sold so that we can be able to negotiate and meet somewhere. So that is the basis for this topic. So it will be most of the time we'll be valuing businesses to see maybe what can be the offer that can be done to such a business. Right, so we're going to start from number 1. So we'll do measures and valuations up to next week, I think, because there are a lot of aspects that have to be covered. But then I will see, because of the other exams that I wanted to do another class so that we can do working capital before we do the main revision class, because I think the major topic that is left, which is important, is working capital. But now the challenge is I'm not very sure if I will get a chance to give you an extra class. But if I get during the weekend, I will try to give you an extra class. But please, if things are tight, I'm very sorry. I will not be able to do it. Then we'll have to see it maybe together with the revision. But I think we're left with this weekend and the other weekend. The other weekend, I'm going to do a longer session with you or for revision, preparation for the exam the other weekend. So I will decide. But if there's an opening, I may create time next week whereby I can maybe finish off measures and valuations, and I will just check the schedule for the other exams. If it's okay, maybe instead of doing Friday, I can organize a weekend session that is maybe longer, let's say 2.5 or 2 to 3 hours, whereby we can just finish off on measures and the valuations and then do the working capital also. Then the other weekend, we know that we'll then do the offer revision. Right, but I will inform you by Friday. But if things are tight, please, we'll just have to do with that Friday session. Then we just do what we can do. Then the other things we'll do the other week. But my prayer was if we could do working capital prior to division. So I will be informing you. So please check your group by Friday. Right. But next weekend, please, we're going to have a long session. That is around, is it the 20th or so? We're going to have a long session. And those who are doing 3701, I haven't forgotten you. It's only that what happened, there's something that happened, so I could do a class with you today. But I will see how I will arrange for you next week. Right. So you guys for 3701, definitely next week I will organize an additional class in addition to the normal Wednesday class. Right. iSchool Private Limited is a manufacturing company that manufactures a wide range of freezers and fridges. iSchool Private Limited wants to expand their product range and is negotiating with Clear Air Private Limited with manufacturers, which manufactures air conditioning units. So you can see that these businesses are related. Both these ones are producing freezers and fridges. Then these ones, they've got air conditioning units. iSchool Private Limited wants to acquire 100% of the shares in Clear Air Limited and believes that valuable synergies exist between the two companies. Right? There are two things there. You should always check the percentage that is to be acquired, because they can ask you to calculate how much can be offered to a company. So after finding the value of a company, if you want to buy 60%, then you have to calculate the 60% to determine the offer. So always check, are we buying 100% or we are buying whatever percentage? And also check the question, because even if we are buying 30%, they can ask you to calculate the value of the business. If they just say calculate the value of the business, even if we want 30%, we're just calculating the full value. But if they say calculate the offer that can be made, then you have to use our percentage to see what can be offered there. Right. Then, is it the 20th? Someone is telling me that exam date is the 20th.
Yes, 20th of May.
20th is a what?
Exam. We only left with next weekend.
No, I want to understand. Today it's 7.
Yes.
So are you saying you're writing on a Saturday?
Yes.
Yes.
Is that
We
possible?
are left with the 13. It is. Yeah, we used to like since COVID, we were writing Saturday session.
I mean, for this module, it has never been written on a Saturday. I know the modules that are normally written on a Saturday, but this one, it is not
Yeah, it's
normally
part of
written.
them this time.
Yeah, okay, it's okay, not a problem. Thank you for letting me. So, in Mark 3601,
It's on the 22nd.
okay, so no problem. What I will do is definitely next week. So, if it's like that, we're going to do it like this. Next week, we will do the revision. Is that right? Then in that revision class, I will incorporate working capital. Then the other, if we have not, then the other Friday, I will try to also do something on the working capital also. So the revision will do it during the weekend. Then this Friday and next Friday, I will make sure that we cover measures and valuations and working capital. That's how we'll do it. Thank you so much for letting me. So that means next week we don't have to organize a mini revision. We should organize a major revision. So I'll be telling you what will happen there. So maybe we can start on Friday. I would think what I'll do. Maybe we can start the revision on Friday and end it maybe on Saturday or Sunday. Sunday, I think, because I think I've got guys who are writing Monday. So I might need to give them preference on Saturday so that they have a rest day on Friday, the FAC guys. So yours I might organize Sunday. So let's I will verify by Friday, but I think Sunday will be the best because these guys are writing on Monday, so I might need them to have a rest on Sunday. So I might use do with them on Saturday, then you guys on Sunday. I will verify. I will give you the full program. So measures and valuations. Okay, let's do this. Measures and valuations. We do them today, Friday, and the other Friday. We'll do measures and valuations and working capital. The other Friday. No. I will see what I will do. I wouldn't like to meet you a day before your exam. Not possible. Okay, I will see what I'll do with the other Friday. But this Friday we're meeting. I'll be doing measures and valuations and probably working capital. I'll try to do measures, valuations, and working capital. Then the Sunday we do the full revision. The other Friday I can't meet you, so I will see if there's a class that I can shift, so that maybe I meet you earlier because I don't want to meet people a day before their exam. Right. Okay.
All right.
So thank you so much for alerting me. Thanks very much. I was off. What I call off. I was thinking that you are writing the other week. Thank you so much. Thank you so much. Right. So the other thing that I wanted, I said there are two things here. The 100% and number two, they believe that there are synergies between the two companies. When they say there are synergies, this is the concept that 1 + 1 is not always equal to 2. What you can do on your own and what I can do on my own is, if we combine them, they are less than what we could do if we work together. Just imagine if at the beginning of the day we're staying together. Then you do your own things from morning, your own cooking, your own washing, your own everything until the evening, whilst I do everything on my own. Then we compare what we do there and what we'll do if we sit down in the morning. Then we agree, you do the washing, you do the cooking, you do this, you do that. You'd find that if we're working together, we'll do more things in that day than if we were saying each person for himself. So when another company buys another company, there are advantages that will arise which they didn't have separately. Those are what we call synergies. For example, if they were running 2 adverts on television, paying 20,000 each, they might run 1 advert. Instead of paying 40,000, they will now be paying maybe, let's say, 26,000. Right. This company might have an experienced management team. This one is new. The managers are not yet experienced. When they combine this new younger blood, they can bring in new ideas. Also, this old guard with experience, they can bring their experience. When they combine, they can come up with a major force. So when we talk about synergies in these modules, we mean the advantages that will arise because of the combination of the companies. Right. I'm going to tell you where it's going to come in. And I'll show you what are the examples of synergies. Right now, our question: draft a report to the directors of high school limited limited and give your opinion on the following. Give your opinion on what the maximum purchase price should be for the acquisition of Clear Air Limited. Support your opinion with relevant calculations and provide reasons for your answer. Right. 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 The maximum purchase price normally we check the present value of future net cash flows, including synergy benefits. Right. There's a difference between a maximum purchase price and a minimum purchase price. So when they say maximum purchase price, you also include the value of any synergy benefits. That is those advantages that are going to arise because of the combination. But if they say minimum purchase price, you look at the value of the business without taking into account any benefits that will come into place when the two companies have merged. I repeat, maximum purchase price, you also include the value of the synergy benefits. That is the advantages that are going to arise because of the combination. Whilst minimum purchase price, you don't include the synergy benefits. You just include what are the present value of that business before taking into account the advantages that will arise due to the business combination. Right. So now we want to do our calculations. As we go, I will be explaining the principles. As I said, that we don't have time for me to go through the principles on their own. I think you heard that my sister scared you by saying the exam is on Saturday. Right. A abridged statement of comprehensive income. This is the statement of comprehensive income for 2014. Right. Normally, we don't use, there are many methods we can value a business. We can use these maximum purchase prices, the minimum purchase price. We can use the free cash flow method. We can use the net asset valuation. We can use the earnings multiple method. Right. You would find that our main focus when we are valuing a business, we don't normally look at the past. The past can form a basis, but we are looking into the future. 31 December 2014 is the year that they've passed. These are the financial statements that they've given us. But when you are valuing a business, we don't look at what has happened. You look at what will happen. What is it that I'm going to get in future? Right. So this is 2014. Let's read what they are saying now. Notes. The directors of high school limited have just entered into an agreement with supplier A for materials and components at 75% of the cost that Clear A Limited is currently paying. Raw material purchase from supplier B will cost high school limited 10% more than what Clear A Private Limited is currently paying. These are what we call synergy benefits or synergy costs. So we don't, when we're looking at maximum purchase price, we'll take this 75% into account. That will adjust so that we will reduce the cost to 75% and will increase the cost of material B by 10%. They are saying if these two companies combine, high school will now purchase the raw materials. It's raw material A at 75% of the cost that they are buying. So we have to reduce the cost accordingly. And for raw materials purchased from supplier B will increase by 10%. So those are what you call the synergies that will arise. So if we're calculating the minimum price, we're not going to take into account all these things. But because we're calculating the maximum price, we'll take these changes into account. Those are what you call synergy benefits or synergy costs. Synergy benefits are the good things that will arise because of the combination, like this one of purchasing the material at 75%, that's a synergy benefit. Then this one of paying 10% more, that's a cost. Right, so we'll take them into account because we're calculating them maximum purchase price. Right, so now let's look at the value. So we're saying these materials will cost at 75%. So we're going to have raw materials purchased from supplier A would say 180,000 times 75%. What do we get? Because they said they will now buy at 75%. $135,000. Thank you, guys. Right, then raw material purchased from supplier B. We are told that this will now cost 20% more. So times 1.2, which is 120,000. Sorry, these are costs. Can I just put a negative here? Because I see that I left out something. Right. Then the turnover is 850. There's no note, so we assume that it will remain at 850. I left the turnover here. Right. Then labor costs of 250. They are saying number 2. We should go to number 2. Right. High school's employee salary fall within a larger scale band than that of Clear A Private Limited's employee salaries. In order to facilitate a salary adjustment, the labor cost of manufacturing will increase by 15%. So there will be an increase of 15%. Labor costs, manufacturing, there will be an increase of 15%. So that's 250,000 multiplied by 1.15. What do we get? To 8,700. Right. Then next, depreciation manufacturing equipment. Right. When we're using the when we're calculating the maximum or minimum purchase price, we only use the future cash flows. We only use future cash flows. So the depreciation normally, you know that that's a non-cash flow item, so it should not be included. But let's go and read number 3. The depreciation is calculated at 20% per annum on the manufacturing machine. Assets will be taken over by ASCO Private Limited. Right, so that depreciation will not, although they are taking over, that is a non-cash flow item. Because we'll be calculating the cash flows. Right. So our depreciation, sometimes they can tell you that state why or show all items. So we can say non-cash flow items. Right. Then next, marketing costs 45,000. High School Limited has its own marketing division within the company. And the projections by the head of marketing show that the total cost will be 80% of what Clear A Limited is currently paying. So it's 80%. Marketing costs 45,000 multiplied by 80%. What do we get?
$36,000.
Right. Thank you, guys. Then there's share of head office costs. Share of head office costs. This is an allocated cost. We don't include it. Unless if they say that there will be incremental costs that will arise relating to the head office that will arise from this acquisition. Right, so allocated costs are not included. Right. So we've dealt with 1 up to 4. Let's read the other additional information. ISCO Limited is an old piece of manufacturing equipment that will be sold immediately now. After acquisition, it will be sold for 20,000. So that's in a money that will come in. So we should remember that 20,000, but we don't include it on the annual cash flow because it's not an annual cash flow. So for now, I'm not including it because we want to determine the annual cash flows that will be repeatedly earned or incurred every year. We have to value them separately. So after valuing them, then we should add this 20,000. So if there are any assets that will be sold now that they represent an inflow, which should also be included within our valuations. Right. Then the total annual cash flow upon acquisition will occur for an indefinite future. We can therefore assume that the annual cash flow will occur up to infinity. Right? They can give you a number of years, or they can give you up to infinity. Right? ISCO Limited requires a fair rate of return of 20% per annum. So this is the fair rate, 20%. It is expected that all the costs and revenue for the division would increase at 14% per annum. Ignore the effects of taxation. Right. So let's calculate our annual cash flow. which we also call the free cash flow. So actually, this is part of the free cash flow method. So up to infinity, this is the cash flow that they will expect, but it will increase at 14% per annum. Right. Now the value of the business free cash flow divided by work minus G. Right. So that means actually the free cash flow that we take here is the free cash flow in year one. It's the Gordon dividend growth model. Remember our Gordon dividend growth model. That's G1 over KE minus G. That's the same formula that we use to value this business. So we'd say we know that the work is the fair rate of return that is expected, the cost of capital 20%. Our G is 14%. So to find the value of this business, we're going to say $271,500 multiplied by 1.14 divided by 0.2 minus 0.14. What do we get? All right, what do we get? Okay, thank you. 5. Okay, thank you guys. I noticed in the answer 5,158,500. So that would be the estimated value of this business. Any questions? No questions. Right, so that's how we calculate the value if we are asked in this question. But even if they could have said which number, this one's here, the 271.
Yes,
Right.
1.14 and the denominator, please.
The 1.14 is the, remember the growth rate is 14%. So this one is the current cash flow. We need the cash flow in year one.
Yeah.
So, and we are told that the cash flows are going to increase by 14% each year.
All right.
So to multiply by 1.14, we're increasing by 14%.
That's fine.
Right, then at the bottom
denominator?
is the cost of capital. The 20% is the work, that's 0.2.
Is it in the question? Sorry, maybe I missed that.
Yeah, maybe you lost it when I was pointing to them. I did point to them. I think the 14% is still pointed here on my paper.
Okay, all right,
And the 20% is given here.
all right, thank you.
Okay, thank you so much. Any other questions? Right. So that would be our answer to the first part. Then the second part, discuss any non-financial factors that should play a role in the negotiation of the final purchase price. Non-financial factors. Right. You can consider the culture of the other company. Would the cultures of the two companies fit? Because it has been seen that some mergers and acquisitions, they fail because whatever the other company, the way of doing their things does not augur well with the other company. So at the end of the day, the merger will fail. Right. Integrity of management of other companies. When you're buying a company, you have to know the integrity, especially if you're taking over the even the employees. You have to understand what is the integrity of the managers of that other company. They might be involved in illegal dealings or in questionable deeds, which can put our company in the spotlight. So we have to make sure that everything is above board, and we can be able to work well with that other company. Right. You can also consider what we call managerial fit. They can have integrity. So you have to consider the managerial fit or the philosophy of management. You might find that your management teams might conflict when you combine. Right. Because you might find that maybe the direction of the other team and your direction might not be compatible. Right. You also have to consider legislation. For example, competition and tariffs commission, considering that these ones are in the same industry. Normally, mergers will be reviewed by the competition and tariffs commission, and if they find that a merger has been created in order to stifle competition and to create a player that would dominate the market and create a monopoly, it might not be permitted by legislation. All right. You can also consider labor unions and their likely reaction. We have to know what are our employees saying. Even if they are not unionized, we have to also seek their ideas. All right. Then other stakeholders, for example, shareholders. Whilst we are negotiating, we should know what is the opinion of our shareholders. Are they in support of this? We might have a flight of shareholders if we do something that might not be in favor of our shareholders. So there are many reasons that you can take. And those reasons would depend on the scenario on the question. Sometimes they can tell you about an outside organization. You can even talk about political issues, the stability of the foreign country. You can talk about the availability of labor in that country and stuff like that. So you just check the scenario. So this one, there's no standard answer. Of course, these reasons that I've put them deliberately because they usually fit in any type of question. But there can be other question-specific reasons that you might have to deal with. Any questions? If we don't have any questions, let's quickly do another question. Question 2. Financial Times, Johannesburg, April 26, 2015. An agreement was reached today to create South Africa's third largest company for fast casual chicken restaurants. Bados Limited and Naselos Limited announced this definitive agreement today, under which the two companies will create a new local powerhouse in the quick service restaurant sector. With approximately 2.4 billion in sales, over 1,000 restaurants, and two strong, thriving independent brands, the new company will have an extensive local footprint and significant growth potential. The new local company will be based in Johannesburg, the largest market of the combined company, Balos Flame Chicken, BFC Limited. So this is like a merger whereby two companies are joining together. Under the terms of the transaction, which have been unanimously approved by the board of directors of both companies, BFC will take over the property, plant, and equipment assets at a market value for similar aged assets for 40 million and 12,750,000 for Bados and Naselos respectively. Goodwill payable by BFC for the two companies was calculated based on the following information. So they calculated goodwill based on that information. Right, then the purchase price will be settled by issuing ordinary shares of R2 each in BFC. BFC will not take over the intercompany shareholding. Right, when they say intercompany shareholding, that means Bados holds shares in Naselos and Naselos holds shares in Bados. In a combined press release, Alex Payne, executive chairman of Bados, and Chuck Flem of Naselos said, by bringing together our two iconic companies under common ownership, we are creating a fast food powerhouse. Our combined size, local footprint, and industry-leading growth trajectory will deliver superb value and opportunity for both Bados and Naselos shareholders, our dedicated employees, strong franchisees, and partners. We have great respect of each other and are looking forward to working together to realize the full potential of these two extraordinary businesses. Right, then these are the statements. So you can see that under Bados here, Bados, they own 110 million shares in Naselos. Whereas Naselos here, it owns 125 million shares in Bados. So they've got what we call cross-holding. When you talk about cross-holding, we mean the two companies in the deal. The other company holds shares in the other, whilst the other also holds shares in the other company. That's what we mean by cross-holding. Right, draft a report to the board of directors of BFC addressing the following issues. I'm very sorry, on the first question, they said draft a report, but I didn't do it in the form of a report. But always when they say draft a report, please start with the format of the report. Or even if they said a memorandum, we know that it's to, from, date, subject. Is that right? I will not do it, but just know that whenever they say report memorandum, you say to, then you write board of directors, BFC. From, you can put your name or your title. Date, you put whatever date you are writing the exam or any other date that you want. Subject, you then write whatever the topic. That means you can say, like in this case, you can say number of shares to be issued to shareholders of Bados, excluding Naselos, and Naselos excluding Bados. Right. So now, let's do this question. Please review these questions when you are alone so that you can see what is happening. One of you today, I saw that she was working, sending me questions. I think there's a figure that I was given which was wrong. If you saw in the group, that figure was wrong. I think someone gave me a wrong figure, but it's not a problem. You just fix it and then you sort it out. Please work. These are the days to write. Do more questions. And don't just do what you are doing. Go back and do some questions that we did and even some which we didn't do. And if there are any challenges, feel free to contact me. Please, I'm sometimes busy. So if you see me, I might even answer your message tomorrow. And if it's urgent, you want to understand it there and then, give a call so that I know that it's urgent. Because normally if I receive a call, I know that I have to attend to it earlier than whatever other issues that I'll be attending to. Because normally maybe you are studying that time, and for you to wait for my response tomorrow or after 4 hours, you might even forget about what you were asking properly. So if you're studying and you feel that you need to understand there and then, call me. If I cut, normally I'm in a class, immediately when I finish, I will call you. So if it's urgent, please don't hesitate to call, either WhatsApp call or a normal call. Because if you just send a WhatsApp, you might receive your reply after 5 hours, and sometimes it might not be working for you. Right. So please, these are the last days of your exam, so we don't want you to write again. Right. So when you are valuing such a business, when they talk about this goodwill and stuff like that, what they say that goodwill has been calculated using the following, then you know that you have to value the business in terms of its assets plus goodwill. When you see such a question, you have to know that then such a business has to be valued in terms of the assets plus the goodwill. Assets plus goodwill. Right. So you leave the assets taken over, which is this one. Then we add the goodwill to get the value of the business. So whenever they give you the question like this, so the first thing that we have to do is to calculate the goodwill. After calculating the goodwill, then we have to calculate the value of the business by adding the goodwill to the net assets. Right. Then we know that this is the value of the building, of the companies. Then we take account of the cross holdings, because they said that if they are cross holdings, like in this case, there's cross holding, as I showed you, that Bados invested in Nacelos and Nacelos invested in Bados. And they also said we should find the number of shares excluding Nacelos and excluding Bados. But if they do not say excluding Nacelos or excluding Bados, there will be no need for you to deal with the cross holding like what I will do. I will show you what I mean. So let's first calculate the goodwill. Right, the goodwill is the present value of what we call the super profits. So we can say step one, calculate your goodwill. So we're saying goodwill is the present value of super profits. And the super profits are equal to the anticipated profits minus the return on assets. Right. So now we want to calculate this goodwill here in terms of this business that we have. Right. We'll have our Bados, Nacelos. Right. The anticipated profits I think the figures are given in millions, so I'll just put 1 million here. Right. The anticipated profits were told that there will be 7585 and 178. So that's 7585. 178. Right. Fair return on assets. Right. The fair return for Bados, it's 15. This is the fair return. It's 15%. whilst that of Naselos is 10%, and their assets are given here at market value. So we'll just take 15% of those values and 10% of those values. That's right. So we'd say 40,000 times 15%. Then 12,750 times 10%. Right. I'll do the difficult one, which is the second one. Can you give me the easy one? I think it's also difficult, so let me do it. Am I right there? Just verify I'm
Yes.
using the God-given calculator. I don't want
Yes.
you to get confused when you are alone. Right. So these are the super profits. The difference is the super profits. Right. I'll tell you the meaning of these figures then. So this will be your super profits. Right. What we are saying is the assets on their own, without the name of the company, they can generate 6,000 for Bados. But because Bados has created other advantages, for example, an experienced workforce, good management team, good location, customer loyalty, because of that, they are getting 7,585. Same as Naselos. The assets, if they were held with anyone else, they could generate 1,275. But because they are held by Naselos, it has created some other things like customer loyalty, linkages with suppliers, good relations with suppliers, good relations with government officials. They are getting 178. So the difference is what we call the super profits. So these are the super profits. So the super profits are they give us the value of the other advantages that are associated with the business other than reflected in the assets of the business. Right. Then you have to check for how many years are we expecting these super profits. Right. These super profits are being expected for 5 years. And the other one is what? 5 years again. So we can say number of years, 5. Why are they limited? The advantages that we have right now, in the future, you create new advantages. So they will have a time that they will expire. Right. Then the fair rate of return. It's 15% here. Then it's 10% there. So then can you find the present value? So you are saying this is the PMT. You make this your PMT because it's an annual super profit every year. Then this one will be the number of years. They will be for 5 years. And this one will be the fair return. So can you find your PV there? So we can say equal to present value. The rate is this one. Then the period is this one. The PMT is this one. The FV is 0. Let me just multiply it by -1. So that's our goodwill for each business. You can use your financial calculator. Please, if you don't know how to use your financial calculator, I always say that please make sure that you inbox me. I do a session with you, or I first give you the booklet. If you don't understand again, you can call me. We can just do a session. 15 minutes will be done. How to calculate these things. You can just come up with the sheets that we've done, then I can show you how to do it. Please make sure that the time that you go to the exam, you're comfortable with this. Any questions? Right, step 2. Calculate the value of net assets taken over. Which will be the assets plus what? Goodwill. Right. Right. Remember that we told that these are the assets, the property, plant, and equipment assets. So say so if we liabilities, you subtract the property, plant, and equipment. So if you are given the net assets, you take the net assets. So say 5313 1914. So the net assets are not this, they are 40,000 and 12,750. Then goodwill 5313 1914. Then we get our total. So that means the total value of each company is my friend. If there was no cross holding, remember our question is to determine the number of shares that the shareholders of each company are going to be given in the new company. Right? If there was no cross holding, or if they did not say excluding Nacelos and excluding Bados, we're just going to take the value that we got and divide by the value of the share of R2 each. They are saying that in the new company, the shares are R2 each. We're just going to take these values and divide by R2. That was going to be our final answer. But because there's cross holdings, we have to take into account the cross holdings. Right. So we have to go to step 3. So this was not going to be necessary if there was no cross holding and if the question had not said excluding. So if the question had not said excluding, even if there's cross holding, we're going to ignore what I'm going to do now. Right. A proportion of shares owned by Bados in Nacelos. We have Bados owns 110 million shares in Nacelos. And Nacelos has got 550 million shares. If you can see the shares, you should be very careful. They are R1 each. If they were R2 each, we're going to divide by 2. But these are R1 each. That means they are 550 million. And Bados bought 110 million. So we can say that is equal to 110 divided by 550 multiplied by 100. What do we get? What do we get? Thank you, 20%. Then proportion of shares owned by Nacelos in Bados, which is equal to, right, they own 125 million shares out of 1,250. So if we say 125 divided by 1,250 times 10% times 100, sorry. I was already on the answer, which is equal to 10%, which is straightforward. Right, so this is the cross holding. Bados owns 20% in Nacelos, and Nacelos owns 10% in Bados. Right. Right. Then we then calculate the total value of each company. Calculate the total value of each company. Right. Including the investment in the other company. So I think the value of Bados is actually the 45,313 plus 20% of Nacelos, because they own 20% in Nacelos. That is the actual value of Bados. Then the value of Nacelos is the 14,664 plus 10% of Bados. So right, we can create our equations here. I want to do maths now. Right. I will let Bados be B. Give me here. I'm not doing mathematics. Then let Nacelos be what? N. Right. So we're saying Bados is equal to a 45,313. Let's remember that our figures are in millions, plus 0.2 of Nacelos. My 0.2, my friends, is the 20% that they own in Nacelos. And at the same time, Nacelos' value is 14,664 plus 0.1 in Bados. Right. Now, since we know that N is equal to this, we can replace our N with this to solve our equation. So B is equal to 45,313 plus 0.2 by 14,664 plus 0.1 B. Right, we're doing simultaneous equation here. We know that N is this, so I've replaced this N with this in this first equation. Right, so then we get B is equal to 45,313 plus, can you say 0.2 times 14,664? $2,932.8. Thank you so much. So that's 2,932.8. Right. Then plus, can you say 0.2 times 0.1 B? Right. 0.02. So that's 0.02 B. Right. Then we take the B to the left-hand side. We say B minus 0.02 B is equal to 45,313 plus 2,932.8. We get B minus 0.02. When we say B is just like 1. When we just say B is just like 1. So if you say 1 minus 0.02, we get 0.98. B is equal to what? What do we get? 45313 plus 2932. What do we get? Thank you. 48245.8. Right. Then to get our B, we would then say 48245.8. Then we divide by 0.98. What will we get as our B? Since these are millions, you can just put, let's say, for example, to 3 decimal places. It's now mathematics, my friends. 49,230.41 million. So that is the value of B, including their investment in Nacelos. Right. Then when we know B, then we can calculate our N. That means our N is equal to 14,664 plus 0.1. We now know our B times 49,230.41. What do we get? Right, 19,587.04 million. So that is the value of each company, including the investment in the other company. Right. So now, step 5. Calculate value of each company. Excluding the cross holding. Right. Bardos, this value it has of 49 million 230.41. We know that Nacelos owns 10%. So we would say minus 10%, or maybe we can just say times 90%, or maybe so that you can see. Let me say minus 10% times 49,230.41. What do we get? So this will be the value of Bardos on its own, excluding excluding Nacelos, which they're asking about. Because in their company, 10% is owned by Nacelos. What do we get? 44,307. 0.37. Right. Then Nacelos 19,587.04. Remember, Bados owns 20%. What do we get? $15,669.63. So this is the value of the separate companies. Then our last step, which will be step 6, we can now calculate the number of shares to be issued to the shareholders. Issued to the shareholders of each company. Right. We know that the shares that are being issued to these shareholders are for R2 each. So we then divide by the price. We know that the value, we know it. So we'd say Bados would be equal to 44,307.37 divided by 2. What do we get? $22,153.69 shares. Million, sorry. These are million shares. Remember, we're dealing with millions. Then N Nacelos, maybe let me just write in full now. There's no need for me to use the B's. 15,669.63 divided by 2. What do we get? $7,834.82 million. Right. So this is how we determine the number of shares if we are given the question in such a manner. It's easy, isn't it? Right. So my friends, review these questions during the week before we meet. So when we meet, we're going to continue with the same document, because I think I might need to do about 2 or 3 variables. There are different ways, because we need to do the earnings multiple method. We need to do the net asset value method, so that you know all the methods. So I will continue with this on Friday. Then during the weekend, we'll do an overall, whereby I will do I'll have some questions. It will be past paper based. So I will create a sample of a paper, then we'll use it to answer these questions. So thank you so much. Very sorry for disturbing your Sunday. Please look at what we've done if you didn't understand, so that you can raise up your questions when we meet. Thank you so much, and God bless you richly.
Uncle.